Happy New Year. We welcome you today to the 2023 Economic and Financial Market Outlook webinar featuring my colleague, Anthony Valeri, Director of Investment Management for Wealth and Fiduciary Services. Anthony has over 30 years of experience in wealth management and is often quoted in the financial media. I'm Chris Constein, Director of Wealth Planning, serving as your moderator for today's webinar. Anthony is going to provide a review of 2022, the outlook for the stock and bond markets in 2023, the path of the economy, recession risks, inflation, and key themes for investors. We will have time for Q&A at the end of our call today, but now I'd like to hand it over to Mr. Anthony Valeri. Anthony, take it away.
All right, thanks very much, Chris, and thank you everyone for joining today. Would like to start with our overview of the markets and the economy, and we'll, touch on all our thoughts as we look ahead to the new year, what investors can expect. First, let's get started with the review of 2022. In the fourth quarter, a rebound for financial markets and investors benefited, with most asset classes positive during the fourth quarter of 2022. Developed international stocks led the way, followed by, in the US, the Dow Jones Industrial Average was the next best performing index, representing large cap US stocks. You can see the rebound in emerging market equities and various categories. For the broad S&P 500, up 7.6%. And interestingly, on the far right, the NASDAQ composite, comprised mostly of your tech-heavy index, still struggled, down 1% for the quarter, but a nice rebound in the bond market as well. So a bit of a reprieve in the fourth quarter, but 2022 was still historically weak, and no way to sugarcoat it. A tough year if you were an investor. Commodities, the only asset class finishing in the positive, but most of those gains came in the beginning and first half of the year, after which commodities declined. And you can see the broad-based declines across a number of asset classes. Even fixed income didn't provide much of an offset. I'll get to that more in a moment. The NASDAQ was the lagging index. REITs underperformed as well, but just tough declines across the board for investors. From an equity standpoint, the S&P 500, including dividends, down 18.1%, seventh worst calendar year on record. If you're looking forward, any kind of silver lining, stocks have only been down 2 years in a row, 4 times, going all the way back to 1920. So a limited probability. It's not without of the realm of possibility, but still history would be on our favor for things to improve going forward. And we'll talk more about that throughout the webinar. Diversification did fail investors in 2022. This is a chart of the 60-40 stock bond portfolio, a widely followed strategy comprised of 60% stocks, US stocks, and 40% US bonds, down 16% if you just take a passive approach to it in 2022. That's as bad as it was, or the worst since 2008. And you can see it almost rivaled 2008 and really puts into words or into pictures the extent of the decline for a diversified portfolio. So it hurt when bonds didn't provide that offset. And just to put it into perspective, it was the worst year on record for high quality bonds, down 13%. If you survived it, things will get better. And just to put that into perspective, the worst year prior to that was 1994, down 2.9% using the Bloomberg Barclays Aggregate Bond Index. So a tough year for investors. Diversification, you know that. So let's move forward. And what really drove that and what will drive the outlook for the coming year was the Fed and Fed interest rate hikes along with inflation. 2022 saw the most aggressive Fed rate hike campaign of the past 30 years. This caught investors off balance, punished equity valuations, and led to higher interest rates, all of which led to those weaker investment returns. You have to go back to the early 1980s to have a more aggressive Fed rate hike campaign than what we witnessed in 2022. On the bright side, the Fed is getting closer to ending their rate hike campaign. That's likely to happen in the next few months. A 25 basis point rate hike is expected in February. The Fed says they'll take the overnight rate to over 5%, which would mean another 25 basis points at least in March. So we do see light at the end of the tunnel. The Fed has been very hawkish, however, still saying that they will need to raise rates and they'll have to keep them high over 2023. And this presents a risk going into 2023. But again, we enter the year with cheaper valuations for stocks and bonds. Inflation is likely peaked. This is what drove the Fed to hike interest rates. Inflation, as measured by the Consumer Price Index, peaked at 9.1% in June of last year. It has steadily declined. We get an update tomorrow with an additional decline expected for the CPI index. Core rate's been a little more stubborn, but that too has begun to decelerate. So there is very firm evidence that inflation has peaked. This hasn't influenced the Fed. They continue to remain fixated on raising rates. One way to look at light at the end of the tunnel and how we get through this is to look at what CPI inflation would do under a variety of scenarios. And here we looked at the CPI index and then just mapped out if it were to increase 0.1% per month, 0.2% per month, all the way to 0.5% per month, what would that translate to in terms of an annualized CPI rate? And you can see that under most scenarios, the CPI, in all scenarios, the CPI rate on an annualized basis decelerates. And especially in that red line, if it's 0.2% per month, it slows to just over 2% by November of 2023. For the record, since inflation peaked in June, it has averaged a 0.2% per month growth rate, which suggests that this slowdown in inflation would continue and should give the all clear for the Fed to ease off on their Fed rate hike campaign. So inflation is set to slow. A number of indicators continue to support that. But again, that will provide some relief, and we'll see if the Fed reacts to that. Now, with regards to a recession, that is the problem. The Fed remains fixated on raising rates, and by doing so, they raise the risk of a recession. In our view, a recession is a 50% probability this year and would not rule it out for potentially 2024. The one main pillar of the economy that continues to contradict recession risks is the labor market. Total US job growth was very strong in 2022. And you can see the second strongest year annualized since 1970. Of course, we do have a growing population, so these are not population adjusted figures, but still shows on an absolute basis, the strength in job creation in 2022. You do not have a recession when you have this kind of job market and labor market strength. Similarly, in terms of job openings, remain very, very elevated. This is the ratio of job openings to job seekers. It has come down in recent months, but remains historically high. There are a lot of job openings, and you can see how much higher this ratio is since 2000, and it's just well above the prior peaks and just shows the number of job openings out there, which speaks to the strength of the labor market. So the Fed is trying to slow this down. The more they stick to their guns with a higher rate hike approach, the greater the risk of recession, either in 2023 or in 2024. And again, we would put recession risks at 50%, maybe 60% heading into this year. The other component that is holding up the economy is business investment, but this is slowing. The annualized pace of business investment, about 5% annualized. You can see the post-COVID surge. It has since decelerated, but one of the major pillars of the economy, still healthy, but slowing. And again, this contradicts the recession fears, but given recent data on goods purchases, we're likely to see this slow as well. Speaking of slowing, two of the top tier economic indicators that come out, provide data that we look at are the ISM Manufacturing Index and the ISM Services Index. The 50 line is viewed as the barometer between expansion and contraction. You can see that the ISM Manufacturing fell below 50, remains below 50, and that indicates contraction in the manufacturing portion of the economy. However, that only represents about 15% of the US economy. The Services Index, surprised to the downside last week, fell below 50, indicating contraction. When you take these two together, it indicates GDP or economic growth between 0 and 2%. So very sluggish growth rate, and a reason why there are very elevated recession risks heading into the new year. So both of these, I think, are broad-based indices that show, yes, the economy is slowing. We're likely to see that show up in labor market data, but until it does, the economy can stave off recession. Let me transition to some of the themes that we follow in the in our investment management approach. And one is that of rising rates and valuations. The blue line is the inflation adjusted 10-year treasury yield, and we inverted it. And the yellow line is the PE ratio on the S&P 500. You can see how these move in tandem, meaning the higher the real rate, the lower the valuation on the equity market. And this really influenced investment behavior in 2022. So those portions of the market that had the highest valuation, the most speculative areas of the market, think crypto, think some of your higher flying tech companies, those are the ones that underperformed or lagged in 2022. And we think those high valuation areas continue to lag in 2023. The other theme is value versus growth. And when we think of value, we think of more defensive sectors like consumer staples, energy, and we think of growth, we think of technology and other fast-growing companies within the equity market. You can see that value outperformed growth fairly significantly in 2022. This is a 5-year trailing return differential between the large cap value index and large cap growth. You can see that growth outperformed for an extended period of time from 2005 all the way through 2021 and to the end of 2021, and now we've had a reversal. This has a lot more room to grow, or to go rather, to reverse that return disparity. We don't make a big investment bet with our investment strategies, but we are leaning towards value, those companies that do pay dividends, which have been rewarded by sending cash flow back to investors. And we think with rates remaining elevated, that is the right approach as we favor value within the equity market. So still favor value as we're going forward. And part of the reason for that is the equity market, although valuations are cheaper now, and if you're an investor, you're in better footing to start 2003 than you were a year ago. Bond yields are higher, a more attractive valuation, and the same is true for the equity market. You can see how valuations as measured by the PE ratio have come down. This is the PE ratio on the S&P 500, and it's come back down to its period average, but it's not below that period average, which says that the stock market, while cheaper, it really isn't that cheap on an absolute basis. And that suggests that you have to be cautious as an equity investor. We foresee mid-single digit returns based on the earnings outlook and do see periods of volatility given the uncertainty over the Fed, the pace of the economy, and earnings growth. We'll get more to the earnings in just a moment. Within the equity market, you do have more attractive valuations for international stocks, specifically developed international relative to the US. And even after the outperformance of developed international late last year, which developed international actually lagged for much of the year before outperforming late in the year, they're still cheap relative to US stocks. And this valuation discount below the average is still significant. So while we philosophically don't overload on international, we think it makes sense to have a healthy allocation there and potentially look to increase on the international side. So valuation is certainly more attractive there. And then our third theme, based on continued volatility, is that active management outperformed in 2022. Here we show the blue bars, the calendar year returns of the S&P 500. The red dots represent the percentage of large cap managers outperforming the benchmark. And in 2022, 61% of managers outperformed the benchmark. Hasn't been that high since 2007. Passive investments, ETFs, get a lot of attention in the media and have done well, outperforming their active management counterparts. We think there's room for both in an investment portfolio, but that trend of passive investment outperforming, we think, is behind us. And we think with markets likely to remain volatile, we think that active management can continue to add value in investment portfolios. So this is an area that we've shifted a little bit more towards on the active side, and a long trend of passive outperformance likely coming to an end. And just related to this, the top 5 companies in the S&P 500 started 2022 at about a 26% weighting of the index. That's come down to 19%, but that is still historically very, very high. So if you buy a passive index fund, realize that you are getting concentration in just a few stocks, and it's better to be diversified and limit that concentrated exposure within your equity investments. In our view, the biggest challenge to the equity market this year is earnings. Our earnings estimate's too high, and this is the key driver of stocks over the long term, is what are profits going to do? Earnings estimates for 2023 have come down significantly, as they have for 2022. Fourth quarter earnings kicks off later this week, and expecting a 5.5% or a 0% growth rate, or even a slight decline for the fourth quarter. Even with that said, 2022 earnings should come in at about a 5% growth rate. And the 2023 is showing at about a 4% growth rate, which is a big deceleration from where it was just 3 months ago. At the end of September, the expectation was for an 8% growth rate. So earnings season will be key. It will be an indication of whether corporate profitability can remain positive. If it goes negative, that is a risk for the equity market, and I think a real key feature as we begin 2023. We think those estimates are a little bit too high, and therefore likely to come down, which would create some volatility. It doesn't mean getting out of the market, but just understand could lead to that challenging low single digit, mid single digit environment rather that we expect. All hope is not lost, however. Just because earnings or corporate profitability will decline, it does not necessarily mean that it would preclude gains in the equity market. So it doesn't automatically mean a loss. Here are the occasions in the blue bars where earnings decline 10% or more. And you can see the gain in the S&P 500. A lot of these came during a recession. So 2008, 2001, recession-driven earnings decline. If we do get a recession, it's likely we will see sort of decline and not a positive growth in profits. But you can see other examples where earnings declined. And 2015, the most recent example, where earnings declined about 11%, but yet the equity market still managed a slight gain for that year. So that's why we watch earnings, and why it will likely be a headwind for the equity market this year, but it does not automatically mean you just wait it out and sit on the sidelines. It's why we favor value and more dividend paying equities in our allocation. Let's shift to bonds, and bonds are back. Big and significant move in yields higher in 2022. This is the 2- and 10-year Treasury yields. You can see the increase. 10-year Treasury yield more than doubled, the 2-year more than tripled over the course of the year. And this means a lot more yield for investors going forward. So as painful as it was last year in the bond market, the prospects are much better following the rise in yields. We like to show that with this chart. So for those that regularly tune into our webinars, we've used this one before, and yield is the best predictor of future return. The blue line is the 10-year Treasury yield shifted forward 10 years. And the yellow line is the trailing 10-year annualized return of the Bloomberg Aggregate Bond Index. You can see how they track very closely. This is 10-year annualized data. Some years will be better, some will be weaker, but what it tells you is that on average over that time frame, yield is a pretty good indicator of where you'll end up over the longer term. And we very much advocate having a longer 5 to 10-year view when you're an investor. A year to year is something that is just not feasible. So when you look at the rise in the 10-year to just below 4%, it does suggest that 3 to 4% total returns in high quality bonds are possible going forward over the next 5 to 10 years. So this yield is going to translate into better return for bond investors. Big change from 2022. Another way to look at that is to gauge what is the defense offered by owning the 10-year Treasury yield under a variety of interest rate scenarios. Let's start at December 2021. If you bought the 10-year then, it would yield 1.4%. But if rates rose a full percent, and this is specific to the 10-year, we wouldn't advocate investing in a single security, but it does show that it would take over 6 years, about 6.5 years, to recoup from that 1% rise in the 10-year Treasury yield. So the damage to price would require 6.5 years to recoup. Now, fast forward to December 2022, and what a difference, 3.9% yield at the end of December, and you can recoup a 1% rise in rates in just under 2 years. So it's another way to view the higher yields and how they allow better defense for investors. One other, I think it's important as we look at the Fed, and here are futures implied rates about what the Fed will do. And you can see the market is essentially expecting the Fed to raise the overnight rate to between 4.75% and 5% anywhere from April and keep it there through June. The risk to the bond market is this slope here on the right-hand side of the chart. The bond market's pricing in 1 to 2 rate cuts by the end of 2023. Fed Chair Jerome Powell says that the Fed will not cut rates. He says, and their latest meeting minutes suggest that no participants expected to cut rates in 2023. Right now, the decline in bond yields is at odds with that view and suggests that the Fed or the bond market is saying the Fed is going to have to capitulate, pardon me, and lower interest rates in the face of a slowing economy and lower inflation. If the Fed funds rate does stay higher for longer, it will put upward pressure on some of these intermediate longer term yields because a lot of this news is already priced into bonds. So some risk in high quality bonds that if inflation remains stickier, we might see a slight bump up in yields. But in my view, the bulk of the increase is behind us, and we may have already seen the peak in the 10-year Treasury yield. Finally, in terms of a sector allocation in fixed income, we remain focused on high quality bonds. We're really not getting compensated for lower credit risk, and that's particularly true when there's a potential recession or recession risk. This is the average high yield bond spread, and it's hovering right around 5%, which is in line with the long-term historical average. So not a lot of extra compensation for a potential recession and default risk. So we've continued to remain focused. We do have some small exposure to lower rated bonds, but for the most part, focused on high quality bonds, especially after the jump in those yields, and way to be positioned a little more cautiously given the risks in the markets. So I will pause there. Those are my comments on the economy and financial markets. And Chris, I'll turn it back over to you.
Great, Anthony. That's really fantastic information. Appreciate you going over it. And it shows not only how well you know this space, but it also shows that you're courageous because you tried to say the word capitulate. So I applaud you for that as well. And yes, we do have some questions. We've had several submitted just lately. And let me just get into the first one, which is, I know it's not wise to time the market, but how long do I stay in equities and continue to ride this year-long downhill slide? Thoughts?
You know, that's one we get a lot, Chris, and it's a common message that comes up. It's emotionally difficult to ride equity market declines, but if you're planning for a future goal, and as we work together, all of our models are based in financial planning. I think it's very, very important that if you have a longer term goal, to stay committed, because the math will work, the process will work. We don't know the degree of returns, but the longer you stay in the market, the more you're likely to be rewarded. Timing the market's always tough. You have to get it right on the way out and then get it right on the way back in. So you have to actually time it twice. And that's impossible to do. Even the best investors can't do that. So if you've come this far, we would certainly encourage you to stay committed. Don't go to cash. Don't try to jump in and out of the market. That'll just lead to weaker performance over time.
And I like how you mentioned during the presentation about areas in which you can sort of focus additionally, whether it's international, whether it's focusing on value. So it's not just standing pat, it's just saying we might want to focus a little more in other areas. So I appreciate that. Now, another customer asked, do you think a dollar collapse is imminent?
No, I don't think a dollar collapse is imminent. And I know with the recent headlines about Saudi Arabia talking about buying oil in Chinese yuan, Russia making overtures about trying to encourage trade in other currencies. That's been in the news a lot, but every time this is the latest threat to the US dollar, I don't see it happening. There's just simply no counterpart to the US dollar in terms of depth of liquidity and a need to transact global trade. This comes also on the heels of a strong year for the US dollar. It did weaken at the end of last year, and it could very well weaken further, but historically still elevated. And I just don't see a replacement. It will take decades. So I do not see an imminent fall in the dollar. Would not be surprised at weakness this year, just given how strong it was last year. But no, not a fall or imminent decline or collapse of the US dollar.
Great. Thank you, Anthony. Another question, a political one here. What impact with the new 2023 Congress, what will that have on markets?
You know, we have a divided Congress, which should mean a limited impact, but I would caveat that with the two things. One, I would caveat that the recent Speaker of the House vote, which was extended, doesn't bode well for the debt limit, which we will have to increase later this year. Could make for a really contentious fight. If that happens, we are at risk of a government shutdown. Historically, that's brought up risks of a default, that won't happen. Even if we do have a government shutdown, it does increase potential volatility, something we want to avoid, but that is a risk later this year. Otherwise, divided government, we're not likely to see any kind of major legislation with a divided Congress. Longer term, and I don't think this is factored in, this is the second point it's going to make, is that all this debt issuance in a higher interest rate environment is going to start to bite. It's going to take a larger and larger part of the budget, and it's likely to put upward pressure on the deficit. And I think fiscal stimulus going forward will therefore be a little bit more limited, or the government's ability to stimulate, should we have a recession, will be a little bit more constrained. So, the government coming to the rescue, it's going to be, I think, a little more limited in years to come, because those interest costs are going to slowly start to creep up.
Great, good. So we had several questions actually come in and related to the recession and 401ks, which is obviously a major savings vehicle for a lot of our customers. So the question was, are we currently in a recession? And if so, how long and how deep?
I think we're not in a current recession. It's possible. I wouldn't rule it out, but I think some of the major components you look at still aren't signaling. Labor market's just too healthy to signal a recession now. Now, granted, a lot of those labor market, the employment report, the monthly jobs report, is a lagging indicator. I think if we do have a recession, it's likely to be mild, and it could happen in 2024, which is a risk for this year as investors try to manage around what's going to happen then. But I do think it'd be a mild recession. With regards, this goes back to timing the market. I don't know if all investors typically realize, but when you do have a recession, the stock market bottoms before the end of a recession. And on average, and I think shown this on prior webinars, the stock market bottoms on average 4 months before the end of a recession. So don't try to time it on a recession. The other part of a recession, by the time they announce a recession, it's usually over. That's announced by the National Bureau of Economic Research. They usually announce it 7 to 8 months after on average. So way too late to use them as a timing vehicle. Again, if you have a long-term horizon, best to write it out, stay committed to your investment and financial plan.
I've always found that to be so helpful, to be told that the recession was something 6 months ago. Just one more question for you, Anthony, and that one's really about buying gold or silver. Is that something you'd recommend for investors right now?
Both those asset classes have held up a little better recently. We typically don't include them in our portfolios because they're really hard to value and unpredictable. Gold doesn't have a stream of earnings, it doesn't pay a dividend or pay interest, and therefore really unpredictable to incorporate in a portfolio. And I think with bond yields higher now, our view is to look more at bonds than some of these precious metals as a safety valve. So no, we don't incorporate them in the portfolio. It's more of a trade in our view. It's not something that we incorporate in a diversified portfolio.
Great, great. So any final words, Anthony, that you'd like to give to the audience today?
Oh, I'd say thank you everyone for attending, and just remind everyone that we do have a full service wealth management team. Any questions or more information, please reach out to your relationship manager or go ahead and reach out to your wealth advisor as well. Both can be a great help to you, give you more information on how you can invest, how you can do some financial planning. We're here to help.
Great. And just some final words from myself. We just want to thank everyone for their time today. At the conclusion of this call, we're going to distribute a communication on how to access the recording of the webinar. If you'd like to review it again or share with colleagues, please feel free to do that. Also, we're going to have a communication very soon about our upcoming webinar in April. We'll bring Anthony back and make him tell us where what all has happened over the past 3 months. So again, thank you so much for your time. Thank you for being a customer, and we really hope you enjoy the rest of your day. Thanks so much.